Joining us here at Post 9 this morning, Fidelity Investments Director of Global Macro, Jurrien is with us. It's great to have you. Happy Friday, Jurrien.
Thank you. Thank you.
So all of that said, I mean, it's not. You agree that lows are probably in, but what would you need to see on top of that?
Yeah. So my sense has been it's too late to be bearish, too early to be bullish, but the pieces are starting to fall into place. And as Mike said, 20% arbitrary number, and it's really only the S&P cap-weighted index that's up 20%. Equal weight still languishing in the middle of the range. Small caps, micro caps still at the bottom of the range. So I don't want to get too technical of are we in a bull market. But if you think about the three things we need an earnings recovery. We need the Fed to maybe not pivot, but at least be done. And then we need market breadth to confirm that an early cycle bull market's in place, because generally those do not happen without broad participation. And of course, the latter very much related to the two former, right? So I think the Fed is nowhere close to pivoting, but maybe closer to the end of the rate cycle. And when you think about R star, the natural rate, which is about a 1% real rate, add a couple percent inflation, you're maybe at 4%. Fed's going to be at 5.5 in July, presumably. That's significantly above the neutral rate. So I think you can argue that the Fed is close to being done. But we need the earnings side. And here, actually, there are some really promising signs, because the earnings estimate revisions are actually now flipping to positive, and the drift of earnings estimates for 2023 are becoming less negative, right? So you have to kind of look under the surface, second and third derivatives, but there is some improvement there, and I think the market is kind of running on that, even though it's not getting that satisfaction from the Fed.
Right. Are you willing to wait with them?
I don't want to be short this market. It's been, obviously we had a very bad year last year, and we've been in a trading range now for a year, right? I mean, from that initial June momentum low, we've been going sideways, and that's a long time for the market to be in limbo, right? The market generally goes up 10% per year over the long term, 60-70% of the time. So for the market to go down and then sit around for a year takes you really far below that trend, which makes sense because we were kind of in a bubble a little bit in 2021. But we're getting to the point where the market's going to want to declare itself. And the consensus, I think, is kind of short. A lot of people waiting for that elusive recession to start, for that shoe to drop. And it's not dropping, at least not yet.
So do you think it's not going to happen? Because I don't understand how you can say we have seen the lows if we still think the recession's coming.
Well, I often have this conversation with our clients, and when people hear the word recession, it's a very triggering thing, because the only recession in the last several decades was the financial crisis, which of course was a perfect storm, but most recessions don't look like that. So what I always tell them, if you're going to trade on the recession, you need to know when it starts, how long it's going to last, how deep it's going to be, and how much of it is priced in. That's four variables that nobody knows in real time.
But isn't there like average recession, you see 20% decline in the market?
Yes, and we saw a 28% decline last year. So oftentimes the bear market is already over before the recession starts. But my point is, we could be in a rolling recession, right? Manufacturing, PMI's at 46, 47. So there are pockets of weakness, commercial real estate. We saw the bank tremors. A recession likely is coming somewhere later this year into early next year. But the market always looks ahead, not always correctly, but it always looks ahead.
But it sounds like if we did get one, you'd want to buy into it, given that it would give you a refresh on the earnings cycle, right?
If it's a garden variety recession and not a financial crisis, which I don't see why it would be, because if it's a recession, presumably the Fed really would be done hiking, and then it would start loosening rates, which would be good for the banks that felt that pressure. If it's a garden variety recession, then I think the market is able to look past that valley, as long as the promise of easier liquidity is on the other side.
So you're telling clients now to do what? not chase the stock market, go where instead?
To have a diversified portfolio. I know it sounds boring, but
hey, 60-40 had a tough year last year.
60-40 did not work last year, but the 40 side, especially in a recession, is pretty compelling. You got a 3.75% 10-year, you got over 5% on the short end, and I think the 40 will do its job, especially now that real rates, at least using the tips market, are comfortably positive.
That's a good place to leave it for now. We'll watch these revisions as they happen. Thanks, Jurrien.
Thank you.